Time now for Hot Picks. Our next guest says headwinds related to consumer spending at Canadian Tire may begin to ease soon. That's why that stock is one of his top picks in the automotive retailing sector. Let's bring in Garrett Nelson, Vice President and Senior Equity Research at CFRA Research. He joins us from Virginia. Garrett, thanks a lot for joining us. There's been a lot of negative sentiment and commentary around Canadian Tire. What we hear very frequently from certainly portfolio managers who are shunning the stock is they don't like the direction of the Canadian economy. They don't like the direction of Canadians' consumer spending, and they see this company and this stock is very exposed to both those things. Why are you more constructive on Canadian Tire?
Yeah, thanks for having me. We think a lot of the headwinds are priced in at current levels. If you look, the company's earnings peaked in 2021, and they've been under pressure for 3 years now. But what we like looking ahead to next year is they should benefit from much easier earnings comps. And we look at consensus estimates. To us, they appear a bit too low. And so we think the stock will benefit from upward revisions to estimates. The company has cited a lot of the headwinds, pressures on consumer spending, customers seeking value. But we really think that these concerns are sort of overblown here. And we think that they're going to surprise to the upside here in the coming quarters.
What segments of Canadian Tire's business do you like the most? The company this morning, I believe, has just said it will keep its credit card business. So the company has reviewed its assets. What segments of the business do you like the best? There are, of course, the core Canadian Tire banner, the Mark's Warehouse banner, and the Sport Check banner, among other things, and the financing business.
Yeah, Canadian Tire has really pivoted to more discretionary categories over the last several years. Specifically, we think Mark's and Sport Check are going to exceed expectations. We think, expectations are a little too low for those two segments. But you take a step back and you look at this stock, currently yielding about 4.5% on its dividend. So you look at the return of that, that dividend yield combined with some upside to the stock price, and we see double-digit total return potential over the next 12 months. So we do like the stock here.
And just to follow up on what I said before I posed that question to you, Canadian Tire has this morning said it has completed the assessment of strategic alternatives for Canadian Tire Financial Services, what it refers to as CTFS or the bank. Canadian Tire will continue to retain 100% ownership of that business. The company explored options with a range of interested parties. Sounds like it shopped the business around, including several of Canada's leading financial services companies, and has chosen a path which builds upon this business's strong return profile and meaningful earnings stream. What's that telling you, the fact that it shopped this around and has decided to keep it?
Yeah, probably it's just not the right time to part with it. But, the fact that they're looking at potentially divesting assets or doing what they can to optimize their portfolio is a good thing. Too many companies just accept the status quo and don't look at options to unlock shareholder value. And so I think the fact that they looked at that and decided against it is a good thing. And hopefully they will continue to look at all the assets. It is a pretty diversified portfolio they have, between all the different brands and store types, and they'll hopefully continue to look at their options.
Okay, let's move on to another stock that you like in the automotive retailing sector, CarMax, KMX in the U.S. It's a retailer of vehicles.
That's right. This is the big used vehicle pure play. They report earnings in a couple weeks. We really like the fact that they're exposed to the used vehicle market. There's only a couple names that are. Most of the dealerships in the U.S. are mainly exposed to new vehicles. So, CarMax, it's more of a spread business. it's the cost by which they can acquire a used vehicle, and then the price at which they can sell it. Used vehicle prices have fallen by about 20% from the peak here, compared to new vehicle prices, which are down only about 2% from the peak. So we think this drop in used vehicle prices is really going to help stimulate sales volume. We're already seeing evidence over the last quarter or two of that, where they're benefiting from higher volumes. And that combined with lower interest rates in 2025, we're much more positive on CarMax. So we'll see what they report in a couple weeks. But roughly, we think this company can post about 30% earnings growth year over year in 2025. So pretty significant upside. And in our view, it's another company that consensus estimates are too low.
Let's finish with the third pick in our hot pick segment. Automotive retailing is the focus. Lithia Motors, LAD, also I understand a seller of cars.
That's right. This is more exposed to the new vehicle market, but Lithia has, in our view, a best of breed management team. They've grown the company. They've grown earnings significantly over time through acquisition, and we think they're going to continue to do that. They also have a strong history of returning cash to shareholders, but it's a lot of the same themes as for CarMax, where we think lower interest rates are going to help stimulate sales volume, and affordability has quietly improved to the best level in 3 years, thanks to wage gains mainly in the U.S. And so, we like Lithia and see pretty significant